Welcome to Accountancy Academy. I hope all of you are well. Today I discuss about a new chapter, that is accounting for sales and approval, that is easy to be learned. Sales of goods on approval or return basis is a technique of business. In such system, a wholesaler or a manufacturer send goods to retailer or customer with an option to approve, accept and purchase the goods or return the goods within the stipulated period if they are not satisfied with the quality and service of the goods sent to them. Usually, a manufacturer or wholesaler does so with the retailers or prospective buyers for introducing and popularizing a new product. At present, we see that Flipkart, Amazon, Snapdeals are sending goods to the customers on sales of goods on approval or return basis. And here the customers can return the products or goods if they are not satisfied with the product within the specified time, such as within 7 days or 10 days or etc. The buyers or the party to whom the goods are sent may accept such goods as purchased or returned. As soon as the buyers, mean wholesaler or customer, accept the goods or approve the goods, then the sales transaction is to be completed. It is very important to note that the possession of the goods changes when the goods are sent, but the transfer of the ownership changes only if the goods are accepted. It means the buyer gets ownership when he agrees to purchase the goods sent to them. This system is known as sale on approval or return, and the goods sent are known as goods on approval. Now we see what has been mentioned in the Sale of Goods Act 1930. Section 24 of the Sale of Goods Act 1930 provides that where goods have sent on approval basis, the ownership in the goods passes to the buyer. If the buyer indicates approval or acceptance to the seller, or by his action adopts the transaction, in clause A, it is stated that the ownership in the good passes to the buyer when he intimates the seller that he approved the goods, accept the goods, and agree to purchase the said goods, and record the transaction or make payment towards the goods. B. If the buyer does not communicate his approval or rejection to the seller but retains the possession of the goods either beyond the specified time limit or beyond the expiry of a reasonable time limit where no specific time limit has been fixed. If the buyer does not intimate the seller regarding his acceptance or rejection of the goods within specified time mentioned in the invoice, such as 7 days or 10 days, then the seller will consider that the buyers accept the goods and agree to purchase the same, and in future he is bound to make payment towards the goods sent to him. and buyer will automatically gain ownership in the goods. If no time limit is mentioned in the invoice, then after the expiry of the reasonable time limit, the seller assumes that goods are accepted by the buyers or customer and agree to purchase the same. Consequently, the ownership in the goods is transferred to the buyer or customer in accordance with the Sale of Goods Act. It may be explained with an example. A wholesaler sends 90 electric oven costing Rs 1400 each to B retailer on 30th November 2020 without mentioning specific time limit of acceptance in invoice. If it is found on 15 January 2021 that B retailer does not intimate his approval or acceptance of the goods sent to him, then the wholesaler A assume that the goods are accepted by the B and also approve the transaction. Owing to expiry of 45 days, a reasonable time limit, ownership of the goods has been automatically transferred from A to B, means from seller to buyer. A also assumes that sale of goods transaction has been completed. Now we see what type of entries are maintained by the sellers. Accounting treatments followed by the seller depends on the volume of transaction of sales. The volume of transaction of sales are divided in three categories. Number 1, where sale or return transaction are a few. Number 2, where sale or return transaction are more or less regular. Number 3, where sale or return transaction are too many. Now we see what type of entries are made by the seller in case of a few transactions. Number 1, when the seller sends goods for approval, then seller records the entry as sundry debtors or customer account debit to sales account, and the amount will be the invoice price of goods sent. In case of a few transactions, goods sent for approval are treated as actual sales and pass through the sales debut. We know in business there are two types of sales. One is cash sale and other is credit sale. In case of cash sale, the journal entries are made as cash account debit to sales account, and in case of credit sale, sundry debtors or customer account debit to sales account. Here the transactions are recorded as credit sale. Number 2, if the goods are returned by the buyer within specified time limit, then the transaction will be recorded by the seller as sales or sales return account debit to sundry debtors or customer account. The amount will be the invoice price of the goods returned. Number 3, if the customer do not return the goods but accept the goods at invoice price or at price higher than the invoice price. If the customers accept the goods at invoice price, then no entry is required because the seller has already treated the transaction as a credit sales at the time of sending goods to buyers. and then recorded the entries as a Sunday debtors account debit to sales account as a credit sales. If the customer accepts the goods at a price higher than the invoice price, then the seller records the entry as Sunday debtors account debit to sales account for the excess amount. The excess amount will be price at which such goods are accepted minus price at which such goods were sent. If the customer accepts the goods at a price lower than the invoice price, then seller records the entry as sales account debit to Sunday debtors or customer account credit, and balance amount to be recorded. Here balance amount means price at which the goods were sent minus price at which the goods are being accepted. Generally, such problem arises when the buyers intimate the sellers to reduce the invoice price of the goods sent. Otherwise, the buyer do not accept the goods or purchase the goods. In such cases, the sellers agree to reduce the invoice price of the goods sent and make such adjustment entries to ascertain the actual sale and actual liabilities of the Sunday debtors. Such adjustments are made as reversing of earlier entries. Now I speak about very important feature of accounting for sales on approval system. At year ending, it is found that goods are sent to the buyers for acceptance or approval, but the confirmation of the acceptance or approval are not yet come, as the specified time limit has to be expired after the closing of the accounting year. In order to ascertain actual profit and loss, the seller have to work out actual sales, actual value of Sunday debtors and closing stock. So, at the time of closing of financial year, the seller have to pass some adjustment entries against the unsold stock lying with the buyers. Now we see what type of adjustment entries are made by the sellers before closing of the financial year. So let me read number 4. At year ending, for goods yet to be confirmed and for which the specified time limit has not expired. So the seller pass the journal entry as sales account debit or return suspense account debit to Sunday debtors or customer account. The invoice price of such goods to be recorded. At the time of sending goods by the seller to buyer, the seller passed the journal entries as Sunday debtors or customer account debit to sales account credit. We know the sales account is a credit figure and Sunday debtors is a debit figure. In order to work out actual sales and Sunday debtors figure, the seller have to pass the journal entry as sales account debit to Sunday debtors account credit for the amount as per invoice price of unsold stock lying with the buyer. For preparation of final account, the seller transferred the value of the unsold stock to closing stock by making some adjustment entry. Now we see what type of adjustment entry to be made. So let me read number 5. For including such unconfirmed goods with the customers into stock, the seller records the journal entries as stock on sale or return account debit to trading account. The amount will be cost price of such goods. In order to work out the cost price, seller has to deduct the loading, if any, from the invoice price. If market price is given and it is lower than the cost price, then such unsold stock to be calculated at market price. Today, theoretical discussion has become too large, so it will be better to discuss about problem and solution in next video. Wish you success and good luck.